Trading the foreign exchange market carries high risk and may not be suitable for all investors trading on margin. Utilizing leverage can carry an even higher level of risk that can lead to a complete loss of investment funds. So before deciding to trade the foreign exchange market or using any of our software alert products, you should carefully and diligently consider your personal investment objectives, level of experience, and risk tolerance. There is a possibility that you could potentially sustain significant loss. You should not invest any capital or trade that you cannot afford to lose. It is your responsibility to be aware of and understand all risks associated with foreign exchange trading and to seek professional advice from an independent certified financial advisor if you have any doubts. Avoria Prime does not exercise trading authority over your trades. You and you alone exercise discretionary trading authority over every trade.
A question is very basic, then it's still worth to ask it, because, well, you're gonna learn it somehow, obviously. So actually, yeah, it is a very, very good question. Pretty much it is, do I pay the broker or is this free? There are two sides of that question. One, the one that some brokers are going to give you, and they're going to tell you, hey, yeah, for sure, we are free. We're not charging you anything. And then there's the other side of the question where the broker is going to tell you, well, yeah, we do charge some commissions. And in both cases, you are paying the broker. When you see trading as a business, the broker is that fixed cost that you can't really get rid of unless you actually own a broker. And well, in which case you either way still have to go through some cost because, well, they're owning a broker isn't free, that would be pretty cool. But yeah, owning a broker is not free. So basically there are three main moving parts when you have a broker. There are the spread, which is typically the commission or the side where the brokers hide commissions when they say they are free. And the spread is basically the difference between the buying price and the selling price. So think about it like this. Let's say that you buy a cup of coffee, just like the one I have here. You're gonna buy your cup of coffee, let's say for $2, just take of the example. And then for whatever reason, let's say that you want to sell it back to the coffee shop. Well, you bought it for $2 and the coffee shop says, well, if you don't want the coffee anymore, I can buy it for $1. Then obviously you buy it $2, you sell it $1, then you lose $1 or you pay $1 in the spread commission, which is the difference between where you buy and where you sell. And that applies to the exact same principle if you do a short trade, which is a little more complex to explain. But yeah, basically, and just to keep things a little bit simpler to understand, it's basically that's the spread commission, the difference between where you buy and where you sell, or if you're into a short trade, well, from where you sell and where you buy back. Pretty much that's one of the most common commission, well, actually the most common commission, and where the brokers actually hide most of the commissions and stuff. They actually tell you that you're not getting assessed any commissions. What they usually do is that, for example, if they tell you, hey, if we can give you an account type that has no commissions, yeah, that's not gonna have a volume commission, which is actually the next one, which I'm gonna explain in a bit. What they're gonna do most likely, they're not gonna charge you a volume-based commission, but they're gonna make the difference between the buy and sell price a little larger, so you end up paying a little bit more. So then the volume commission, it's pretty much based off, oh, you're gonna trade. I'm gonna talk about stocks just because it's a little easier to wrap your head around. Let's say that you want to buy 10 stocks, then you get charged, let's say $1. Let's say that you want to buy 100 stocks, then you, instead of $1, you get charged 10. I know that stocks markets works a little bit different. There are free commission brokerage, but yeah, I'm just using stocks just because it's a little easier to explain. So FX markets, they don't use stocks. They use something that's called lots. And the more lots you trade, then the bigger the commission. And it's usually expressed in the form of, oh, you're gonna get charged X amount of dollars or what have you for every amount of lots. So let's say that you get charged $10 for every lot, then you trade a tenth of a lot, then you're gonna be charged $1. Let's say that you trade I don't know 0.05, then you're gonna get charged 50 cents and so on. So yeah, that's the volume-based commission. And then there are swaps, which work a little bit different. It's a little bit more complex, but it's basically when you trade FX markets, the FX markets, you basically trade on something that's called margin or margin trading, which comes through the so-called leverage of the account. And it's basically the margin. It's gonna generate, or it's gonna allow you to have more buying power. It's usually expressed of 1 to 100, 1 to 500, so to speak. And that buying power that you get when you place a trade, you are trading as if you were buying 100,000 units of the base currency of any pair. I mean, I know this is getting a little bit more low level, but basically just think about it like this. You're accessing a position size that's very, very big. Obviously, there are interest rates that are assessed, which are called swaps, and those interest rates are defined by the central banks of the different countries. Now, if obviously depending on if you buy or if you sell any given currency pair, there are going to be different rates, which are going to expressed in the form of swaps. And let's say that you hold a position for 24 hours, or well, actually not 24 hours, but you just go through the rollback or rollover from one trading day to another. Then that's going to count as one trading day. I mean that you're holding the positions from one trading day to the other. And then if you do that, the broker is going to charge you a swap, which is pretty much just the net interest rate between the currency that you're buying and the currency that you're selling in the FX market. So that's the third form of commission. And actually, that's the one that's most uncommon to see brokers offering for free, quote unquote. There are a few brokers that offer free swap trading conditions, but usually what they do is they ask you for a minimum lot size, or they ask you for um or yeah, they pretty much just enlarge the spreads, according to the lot size that you trade on or something like that. So yeah, that's the basic overview of the general cost structure that FX trading has involved. Let me know if that makes sense. And that, yeah, hope that it helped explain you a little bit more on how all this mess of the FX market works. So anyways, let's jump to the TA side. I'm gonna hand it off to you, Mr. Nick.
Okay, awesome. So this last week, we basically saw a rejection off of 72, 72,500. So we had a mid-level point that we had rejected off of, and ultimately this was actually the zone that we drew. I forgot when we drew this. Maybe it was like a week or so ago, 2 weeks ago maybe. But basically, when we moved up to this area, we retested this previous price zone. And what tends to happen is when you have an area that acts as support and the market breaks through that area, we can tend to find that it come back to that area and it will now act as resistance. And that's what happened here. So we had a rejection off that level. And then if we actually zoom in this area, because this is a daily time frame. So ideally, if we were going to look at this from just the technical perspective, we would have had some type of hint on the lower time frame that we had some type of shift in structure. So there might be signs like lower highs being printed. There might actually be a shift in structure on like the hour time frame where we actually break market structure and the higher highs and higher lows get broken. We print a lower low. There could be, we come up to that point, we consolidate a bit, and then eventually break structure. There could be patterns, like maybe it's like a head and shoulders pattern up there in that area. But ultimately, we can zoom in and just kind of look at the lower time frames and kind of see what happened. So this is the 4-hour time frame, and we'll go down a little bit more. So here's actually like if we just did point A, point B into the future, and then we have like some other trend lines here that we could draw as well that eventually were broken. So point A, point B, point C into the future, and ultimately we could see that here are the higher lows in the hour time frame, and we could see higher highs. That was taken out. Here's a lower low followed by a lower high, and then we actually have another lower low followed by a lower high, and then we can actually see that shift in structure occur where we actually start to actually get lower lows and lower highs. So depending on, what you were doing here, you could have waited for like this inner trend line or the main trend line to be broken, and actually wait for the second lower low and lower high to be formed to actually confirm maybe that area was actually going to be rejected from just a technical perspective. But that's where we're at now. We're coming back down into this area where we basically had some buying pressure. It doesn't mean we necessarily need to make it all the way down here. Even here in this area, we can see that there was buying pressure, before right here. So that's a technical perspective right there. And then you could obviously line this up with like, let's grab my Fib tool. I can go ahead and line this up with Fibonacci retracement zones and see if this area actually sticks. But that'd be a technical outlook, just kind of looking at what happened this last week and then correlating it with just market structure, some basic technicals.
There we go. Pretty nice analysis, buddy.
Yes, sir.
There we go. So before we jump into the week's summary about what happened, let's go over a question from Mr. Peter. So, it says, and I know you can't recommend anything, and yes, that's very true. I can't, or Nick nor Rob say that we recommend anything to anyone due to compliance. It says, but if you were me and you have made 2.6% this week by Thursday, would you do what I have done and turn off auto trading to protect the gain for the week? So, a few weeks ago, I think we went over a pretty in-depth explanation. If someone actually remembers which call it was, drop it on the chat just so we can use that also as a resource to answer the question. But generally speaking, the way that I personally use NEO is just as with any manual trading strategy or any other automated trading strategy that I can actually get a hold of and understand what's happening. I see it like this. I know that NEO is a good trading strategy. I know that it can have drawdown from time to time. And I also know that Fridays are typically the days where most profits comes in. And I'm gonna try to give a reasoning about why I think that's the case according to data. When you have an algo trading strategy, and actually I'm just gonna use this to segue as well into a small, quick algo trading lesson for everybody. When you have an automated system that happens to, according to what you see, through data, that just happens to make a profit. Usually it makes a profit for a reason. Sometimes we might not even know what the reason is, but sometimes we actually do have at least an idea about why a strategy makes money. But generally speaking, regardless if you know the reason for why a strategy makes money or not, the reasoning or the thought process behind it, it usually always is, okay, you have a strategy that puts your account at risk to some degree, and you get rewarded by taking on that risk on the markets. Well, in the case of NEO, we have to take into account that we're trading around market close, obviously. And trading around the time of the day makes it to where you're trading into a time of the day where there's not much liquidity, price action is a little bit more choppy, and you're most likely gonna go through the rollover from one trading day to the other. So most of the trades are actually get charged the swap fee, the one that I actually explained a few minutes ago. So that makes the strategy a little uncomfortable. We do have a skew for the risk reward to where the losses with NEO are larger than the profits that you get on average on a trade by trade basis. That's also another stuff that makes the strategy a little uncomfortable to trade with. But actually, that's the reason, or that's according to what I've researched, and obviously according to my opinion, that's the reason why the NEO strategy actually managed to, on average, according to data, make money in the long run, because it puts you into a position where big players don't want to take on that risk, or it's not worth it for them to take on that risk, and therefore the opportunity is still there in the markets for us to exploit as a retail trader. Now, going into the question that you were asking, you had a very good week, and I'm really glad to know that, by the way. And you had a pretty nice game from Monday to Thursday. Should I turn off Neo on Friday to protect the gains? Well, it depends on how you view it. You can play it conservative. You can't go broke by not trading. So if you want to not take the odds, then I mean, go for it. It's up to you. And why does Friday seem to have the most profits or seem to be the most profitable day? Well, if we can think about it in the perspective of what risk are we taking versus well the reward that we usually get by taking on that risk. Fridays are a special case because around market close, it means that if we get, which we usually do, a trade that rolls over to the other week, we are not only getting the risk of swaps, we're not only getting the risk of trading during a low liquidity zone, we are actually trading on what I think it's the lowest liquidity time of the day through the well, I mean the most or the lowest liquidity period of time through the entire week because we're actually getting through the weekend. So there is even less volume, and we don't have the risk of the rollover from today to tomorrow. We are actually having the risk of the rollover from one week to the other, where there's the possibility to have a gap against the trades. So, well, we're taking on a slightly bigger risk. It makes sense that we get rewarded with slightly bigger profits on average. Now, that doesn't mean that you should blindly trade on Fridays, especially after having a really good week. It might be that you can think to yourself, well, I made pretty good this week. I don't care how the price action looks like. I don't care how the fundamentals look like for today. Thus I just don't want to risk it. And then you can turn off Neo. And actually, by the way, I wanted to mention that if you don't want to trade Neo on any given day, it's best to use the cycle down or the close all functions instead of the auto trading, because the auto trading is just gonna prevent the orders to get to the broker. But Neo is still gonna fire those trades, but it's just gonna start yelling at you with a bunch of errors saying that the auto trading is not allowed. So yeah, if you can just use close all or cycle down, those are actually going to prevent Neo from trying to place a trade instead of actually Neo trying to place a trade but not getting allowed by MT4. Anyways, I'm digressing. So what I want, or I think my point, or the point being, is that ultimately speaking, it's up to you. Obviously, what I can tell you is not going to be the same case for you because, well, I'm part of the developing crew behind Neo. I get to understand Neo quite a bit better because, well, I was the dude that was coding it. So obviously, my perception about understanding Neo is a little different than your perception. But the general thought process that I would have if I was in your place would be that one. I would just think to myself, well, I had a good week. Do I want to risk or do I want to go through that extra risk for that extra reward on average of trading on Friday, given that I had a really good week? Now, obviously, a past performance is not indicative for future performance. That not only goes to the downside, but also to the good side. If you had a very good week, it doesn't mean that you're gonna keep having it on Friday, but it doesn't also mean that you're not gonna keep having it. So it's pretty much up to you. But if you're gonna wait having a more profitable than usual week versus taking on the risk on the Friday and you just think that it's not worth it, then you can go ahead and stop trading on Fridays. It's ultimately up to you, but I wanted to kind of like give you the tools or the cards to better see, how's the outlook. And it's not something, I mean, I didn't want it to make the answer to that question as simple as, oh, I would do this or, oh, I would do that. I just wanted to kind of like share with you the thought process that I usually take when deciding to either do that or not with my personal account. And well, if you find value in that, well, great for it. You're welcome, buddy. So yeah, that's pretty much my thought process. From here, what do you think, Nick? Should we go into the week review for performance and stuff?
Yeah, I think that sounds good. That or I don't know if you have them on you, but I know one thing that I guess was asked each week was maybe like just reviewing one of the back tests and kind of looking
True.
at
I don't have them just because Robert has the backtest machines. So
that.
yeah, I don't have the files on my computer, but actually let me see what I can do. I'm not sure if you want to add something to what I was mentioning a few minutes before.
Sure. Yeah. Ultimately, I think this is for me, my personal experience with something like that is if you make X amount of profit and you feel good about it, you know, getting clearance from someone else of if you should trade or not trade, if they're right, okay, it's going to feel good. You know, and if you make more profit, but if they're wrong, then you're going to be like, I really didn't think it was right. So ultimately, I think it's best to just kind of go with what you feel is right for that week. Yeah, that's what I actually think on my end, especially if you're on the side of like, hey, I actually did really well this week. Let me go ahead and you know, throw down the boots like today. So that would be my perspective on it. From you know, if we're talking about Neo specifically, or even just you trading as an individual, it's the same thing.
Yeah, exactly. Really good point right there, man. And I agree. There's also this conception around trading about being right or wrong depending on the outcome of the trade. I view being right or wrong in trading on a very on a slightly actually it's not a big of a difference, but I view it from different perspective. I think if you take the decision that was within your trading plan in case of manual trading or actually in algo trading as well, regardless of that decision coming to a profit or a loss, if you took it or if you took the decision based off what your plans were, what your trading plan said, or what your outlook for or growth plan for an account by using an automated system was, I mean, if you followed what you the plan that you developed about how we were going to go about an automated system or how you were going to trade an automatic or a manual trading system, then you made the right decision. I mean, if you were following what you said or what you were planning to follow, then that's a good decision, regardless if it made a profit or not. It's just a matter of following your own rules, you know, as they say. So, anyways, swapping about a little bit for the about the backtest, I did found some files. These ones are not up to date. I think they the last backtesting data that I have goes up to May, but I'm going to share this with you. Actually, just let me organize this a little bit better. Let's just go and use the, let's see. So we have one. Let me filter out only mode 2. There we go. Okay. So let's do a quick review also, just so we have a little bit more backup, you know, and insights about the backtesting data that we have. So this is the backtesting data for mode 2, and this is the backtesting data for mode 1. So just for the ones that are new to Neo, this is pretty much the main difference that we're gonna see between mode 1 and mode 2. Just don't give it that much weight to the actual values or numbers in the P&L, because these are actually money values, not percentages, which in my opinion are the most important ones. But anyway, here what you can see is pretty much that mode 1, it's going to have a very smooth growth curve, and that it's going to have not that many trades. That's almost 3,000 trades from 2008 up until now. So that's not many trades per year. Actually, let's work how much that is. So we have about 2,700 trades divided by, if I'm not mistaken, this should be about 15 years. Let's see, 3, 6, 9, 12, 15. Yeah, like 15 years. So that's about 180 trades a year. So that divided by 12 months, that's about 15 trades a month. So that's not a lot. And actually, it's about in line with with what we see for mode one, which is about 2 to 3 trades a week. I mean, 2 to 3 trades a week, give or take. So anyways, as you can see here on paper, it doesn't say that it had a losing month. This does not mean that mode one can't have a losing month, because it can. The trick behind it is that since mode one can handle, or it's going to scale into a trade on a bigger range in the markets, or hold floating drawdown for longer than mode two, it means that it has always so far come across for a profit. It always has found a way to get out of the market for a profit. Now, once again, these do not mean that it can't happen. This doesn't mean that mode one can't have a loss. It can indeed have a loss. It just happens that the way that it's been optimized for it, we haven't come across a market condition where it actually just had to pull the plug and take a loss, which it does have a safety net feature inside of it, to where if the floating drawdown gets out of hand, where out of hand means, well, depending on the risk profile that you choose, let's say that you're trading with 25% maximum risk, well, it means that if for whatever reason a basket of trades for mode one were to have a 25% drawdown floating, then at the point where it exceeds that amount, is going to just close everything for a loss. It hasn't happened so far. It can happen at any given time, because the markets, well, can do whatever they want. But, well, it's just something to consider. So it's going to scale into a trade. It's going to hold the floating drawdown for a little longer. And because of that, it's going to have a smoother growth curve when it comes to the profits that it generates. Now, if I scroll back to mode two, as I can see here, it has way more trades. It has over 7,000 trades versus the 2,700 that mode one had. So mode two is going to be more active. Obviously, you have more trading activity. You can expect a little longer, or a little, well, yeah, quite a bit more profits, just because the compounding effect kicks in way faster. Okay, so yeah, but the caveat to that is that, as you can see here, the equity chart is more choppy. There are losing periods. There are periods where we stay under equity highs for quite some time. And that's normal. Actually, this backtest went through November and December trading. If I go to the official accounts, actually, I'm going to do that right now. Just so, oh, let me stop sharing the screen. Just 1 second. There we go. Can you guys see the screen?
Yeah.
Okay, there we go. So as you can see here, this backtest period went through November and December, which were the pretty crazy COVID periods. So if I go to the official accounts, let me do that actually. I can see that down period, or that losing period that we had through November and December, this dip right here, I can't find that on the live accounts. Look, let's figure out why. If I go to the breakdown of the month by month profits, I do see that November was negative about 1.5%, and December was actually profitable by a pretty minimum amount, by a 0.2%. But obviously this doesn't line up with these two numbers right here. Well, the reason for that is that, well, since we know NEO, since we actually know that the trading conditions that we had during those 2 months were very far from ideal for a strategy like NEO, we decided to go like, hey, we're going into a market period where it doesn't make sense at all to trade, let alone obviously mode two, which is more subject or fragile to volatility. We just decided to shut off the systems altogether. So that's the reason why we actually hacked the system a little bit more and just avoided that dip into the account, because, well, we understand that that period in time was, well, far from ideal to trade a system like NEO. So we just shut it off altogether. And what it turned out to result from there is that a very shallow trading activity from between November and December. And, well, we avoided pretty much a drawdown period. We had one stop loss. We decided, well, let's stop everything through these couple months, because, well, the markets are way too crazy right now. And, well, that that left us with this little dip instead of this pretty long downturn in the markets. Actually, we would be under equity highs still. from that drawdown period because it was, well, pretty major. So yeah, that's something to consider right there. So anyways, going back to the back test, and well, now explaining a little bit more what goes into the decisions about deciding when to run or when to not run Neo. We can see that with mode 2 we have a different creature. We have on average bigger years, bigger months, but we have a trade-off. That trade-off is that on occasion we do see red months. We do see more commonly periods of times or months where we actually come out at a loss, which can happen with Neo as with any other trading strategy. Even with mode 1, this can happen very easily here. It just happens that the way that the strategy trades is that it allows floating drawdown or floating losses to build up for a little bit of time to avoid having a red month. But if we have to take the loss, then we have to take the loss. There's no that can happen at any given time. So with mode 2, we don't have that sugar. We don't have that little hack, to try to avoid a balance shift. We do take the balance shift with mode 2. We've had actually a few stop losses along the way since we've launched Neo, and well, it's pretty normal. It's pretty in line with what we can expect from Neo. Actually, for some people, we had a negative April this year, and that actually shows on the backtest. So that's actually a really good thing that we actually can line up the red months with the backtesting data. On the official accounts, we did had a profitable April, barely, because with the turn on or off thing that we do, and we let everyone know what we're doing with the official accounts, we managed to bypass one stop loss, which actually helped to have the official account come out at a slight profit instead of at a slight loss back in April. So yeah, that can happen on occasion, as you guys can see. Overall, long term, it seems, according to data, it's a profitable system. And that's the reason why we don't sweat that much in a stop loss. A stop loss can happen at any time. And, it just comes down to, well, it's the nature of the strategy. You can't have an ATM machine where it's not going to lose at any point in time, obviously. Any strategy, it's going to have its weak spots. And, well, mode 2, I don't want to say that it's a weak spot. It's just the section of the strategy or the portfolio that's going to cause more volatility. That's why we say that mode 2 is not that it's more risky. It's just more volatile. If we compare the equity curves, mode 1, as we can see here, smooth. Mode 2, let's scroll down a little bit more, choppy. That's what we mean with more volatile. And as you can see here, there are periods in time where we can go into some drawdown. Actually, 2013 for mode 2 was a red year altogether for the entire year. And that can happen again. It's just normal for the strategy. And if we combine both, if I go here to 2013, it actually mode 1 covered the losses and left us with a little bit of profits. But, if we were trading mode 2 alone, it would be a red year. And that's good. I mean, it's just the nature of a strategy. And we can actually have periods, for example, here where we had in 2010, we had 3 red months back to back. And even though that happened, if I go at the end of the year, it still came out at a profit. So it's just the nature of the strategy. There are periods in time where we're going to just go through some drawdown. And I hope that these kind of like overview of the backtesting data helps out a little bit more to understand what goes into Neo. And actually, I can see here the profit and losses by weekday. As I can see here, Fridays come out as profitable day by quite a bit. And it's because what we covered a few minutes ago, about the risk, about the market rewarding us for taking on a larger than usual risk, So yeah, and actually, if I go to mode 1, it seems that it's not the case. For mode 1, the most profitable days are Thursdays. But for mode 2, since we're taking on a bigger risk on Fridays, well, it makes sense to have Fridays as the most profitable days. So yeah, I wanted to cover this. I hope that this helps everybody understand a little bit more about Neo. And Nikki asked about how big was the risk in this backtesting period. If I'm not mistaken, both of them had a, yeah, I think both of them had a 20%, 20 or 25% max. So I'm not that sure. As I said, Rob is the one that has the backtesting data. Don't hold myself to that. But yeah, I think it was between 20 and 25%. But yeah, I wanted to cover this. I hope this helps understand everyone a little bit more about what goes into Neo. And Alexiv is actually asking a question. So it says, so what are you saying is about fundamental analysis on a daily basis combined with technical analysis to decide for yourself whether to not let Neo trade? Yes, we use pretty much a combination between fundamental analysis for the ones that are new to trading. That's analyzing what's going on when it comes to news related stuff. That's Brexit, that's PMIs, that's rates, that's interest rates, that's unemployment, that's what have you. I mean, what's happening on a fundamental basis within an economy. And so anyways, what I was saying is that we combine both typically when it comes down to decide whether to run Neo or not. What I mean by that is that let's say that we have a high impact news, but that high impact news event happens. Let's say that high impact news happens, let's say at 4 a.m. Just for reference, on my local time zone, the Neo trading zone, it's between 1 p.m. and 3 p.m. Let's say that we have a high impact news at 4 a.m., 3 a.m., moves the market a lot, it spikes all over the place, but then through the day it starts to settle. So even though there was a high impact news, since it's very far away and the impact from that news has already, settled, so to speak, when we go into the trading window, then we can consider trading with Neo, even though we had that high impact news. However, if we had a high impact news that shoots the market in one direction, we go into the trading window, we don't see the market settling, we don't see the market kind of like going into a choppy period, which is usually what we look out for. Then we say, we have a very one-directional movement in the market. We see that it was filled by a news event. We say, we might consider stopping Neo today. Why? Because what we look out for and what we want to see is a period in time with shallow movement. We don't want to see one directional movements going into the trading window. We don't want to see a lot of movement, a lot of volatility happen, regardless if it is a big range spiking all over the place or a big one direction movement going into the trading window, because that's a lot of volatility. And the principle of Neo is low volatility trading. So that's kind of like the general outlook that we consider when it comes to decide whether to run Neo or not. Whether that volatility is caused by just technical analysis and we can't seem to find a fundamental reason for that, or that increase in volatility is actually backed up by a fundamentals reason, and that is pretty much something in the economy, a headline, Brexit, COVID, what have you. Regardless of that, if we see that in the chart, then it's a warning flag for us. Then we jump in the chart, we assess what's happening. We assess, well, the volatility seems to be high, but it's good to go. I think yesterday we had that case, we saw a lot of movement, but it was within what we considered a good enough day, and we traded Neo. But there are also some days where we say, this is way too much, let's hold off trading today. Then we stop Neo that given day. So yeah, hope that helps answering the question. I see that Z Bob, I'm not sure if that's Robert, but yeah, I thought that it was Robert. So let's actually allow Mr. Robert in here for the last few minutes. And actually, while he's joining in the panelist side, I'm gonna go into a little bit of an overview about the last week. Actually, we see Rob, or Z Bob, as we Z on the good old name. Actually, I'm gonna be kind to you and allow you to turn on your camera. So you're gonna be promoted to a co-host.
Hey, what's up, man?
Hey, what's
How
up,
you doing,
buddy?
guys?
Hey, doing
How you
well,
doing,
doing
Nick?
well. Good. How's it going, Z?
There we go.
Yeah.
Feeling liquid, feeling good.
There we go.
There we go.
Susan, you had a crazy day today, huh?
Oh man, I woke up at 4 in the morning and everything was powered off.
Oh,
And
dang.
so
Damn.
still there's no power in our neighborhood and there's no water pressure. And of course, I had a really important meeting at 6:30 a.m. So I used my phone to give internet to my laptop that was powered and still went through the meeting, but didn't have enough juice for this call. But I'm here.
There we go. That's fine, man.
That's a bummer. That's just in your area though, right, Rob? Fernanda, you're good.
Yeah, I'm good.
But does that
lives maybe about 10, 15 kilometers away from where I'm at right now. So yeah, I got to bypass that stop loss on the internet connection.
Nice.
Yeah. But everything's good. How about you guys? How's everything?
It's going well. Yeah, we just we actually went over a few of the back testing results over the last 15 years. So that was cool. Yeah, everything's going well though.
That's good.
Yeah,
Nick, are you gonna go to are you going to the event is it in Orlando?
Yeah, Orlando.
The Avoria event?
I don't have it on my calendar yet. Are you thinking about heading out there?
I will if you show up.
That'd be cool.
There we go.
Yeah, it's actually not that far from where I'm at. It only takes a couple hours to get there.
Okay, cool.
Yeah, it's just a few hours flight from here. So yeah, we might have a full mix into that event. Yeah, let's see where things go.
Yeah, that'd be fun.
Cool. So actually, let's go over a little over the performance last week. Just so we also cover that. And as you can see here, we've come out at a clean profits this week. So that's really good. That's really good to know. And let's do a quick summary. Actually, yeah, as you can see here, we did had a pretty nice week so far. We still have Friday to go, but yeah, it was a pretty good week for the good old Neo. As we can see here, the official account made 3.95%, and that's really good. That's really, really good. That's pretty much how the performance has been these last few days. We've been having a little increase in the slope of the growth that comes out through the increase in volatility. As you guys know, Neo likes to adapt to volatility as well. It's not only bad stuff for it. It's also some good stuff. And yeah, we come out at a almost 4% gain. Actually, if we have a profitable day today, I think we might break the 4% threshold, which is good. Yes. So yeah, that's a pretty brief summary about the performance this week. It was a pretty chill week, actually. We didn't have any interventions, I think, which is good, which is really, really good. Oh, it says that, can you guys see the screen now? Someone on the chat was saying that it was a black screen.
Yeah, we could see it.
Yeah, I can see it fine.
Oh, there we go. So yeah, 3.95% gain for the week. Hits these last few dots right here, which is good. Here we can see the P&L by weekday. So yeah, it was a pretty chill week. I don't think we did any interventions this week, which is good. So yeah, that's actually we're 15% away from reaching the 500% growth in this account, which is really good. A really high risk, by the way, just so everyone actually remembers that. But yeah, that's a really good thing, I think. What do you think, Rob? You think that next month we're gonna break 500?
Oh, for sure, no question.
There we go. So
if we don't, they know who to go after.
Then we know what to go after you, sir, and that'll end the event.
Welcome to El Salvador.
There we go.
No, I think we're gonna do it. It looks, the market's been very cooperative lately. So yeah, I like how things have been shaping up.
There we go.
Everyone seems to be pretty much recovered if they had any losses the previous months. So that was nice to find out.
Yeah, that's true. Very, very peace of mind to have, so yeah, for some reason the people some of the people here in the webinar doesn't seem to be able to see the screen when I share it. But yeah, I mean, it's actually
just share the link and then they can check it out.
Exactly. So Any thoughts, Mr. Robert? Since you showed up late, I'm gonna hand the mic off to you for the last thoughts for the webinar.
I'll talk about a different note. I've noticed that the crypto markets have been suffering the last maybe 2 months or so, and things have really died down as far as all the hype. And I feel like right now people are starting to shift and look at where they can get returns. And equities is a little bit scary right now just because we're at all-time highs and the market is kind of running out of momentum. And crypto is also obviously in arguably a bear market. And so I feel like currencies is perfectly situated to be the investment vehicle of choice going into the second half of the year. So that's kind of my macro assessment of what's happening. I feel like people are looking for returns, but they're a little bit scared to go into equities right now or crypto. And obviously using a beautiful software like Neo is the way to go.
There we go. Pretty good insights, man. And yeah, I've seen that the good old crypto market is having some hard times. And as you said, equities seem to be a little scary to me right now. So yeah.
I wouldn't touch them.
Yeah, I mean, if someone gives me a share of Tesla or something like that, I wouldn't say no. But other than that, I would keep myself a little away from it. So yeah. So Alexei is actually saying that this was a very useful and informative call. I'm really glad that you find value in this one. And regarding about new stuff going or rolling into Neo, we do have some pretty exciting stuff coming soon. I'm not sure how soon, but soon. So yeah, stay tuned, as they say. So anyways,
and maybe I don't know how many people are close to Florida, but maybe some of the people listening are going to be going to the Avori event in Florida. I'm not sure.
Yeah, we might actually have a nice first meetup right there, and some Neo themed.
Maybe we could raffle off a lunch with Fernando.
Actually, that would be a really good idea. Just don't sell my kidneys, sir. You like
or a whiskey with me, or maybe a coffee with Nick.
There we go. All three. Yeah.
That would be actually a very interesting pool to roll. Whether you want to have a lunch with me, whiskey with you, or a coffee with Nick. That would be a very interesting thing to find out,
Do a poll. What would you rather have?
They actually mix them. They can do both.
There we go. Yeah. Anyways, let's wrap up the call. We're about to roll over with Tyler. So, anyways, guys, I hope that you're gonna have a very good Friday. Have a good day and a good weekend, and see you guys in the next call.
Take care.